Hi there. In this topic video, we're just going to take a look at some causes of information failures in markets. Information failure, or an information gap, happens when people make the wrong choices, partly because they have inaccurate or incomplete data. We tend to assume in a world of perfect competition that everybody has full information about the costs and benefits of the products they're about to consume. But of course, the reality is very different. For example, consumers may not understand fully or be aware of the long-term benefits or the long-term costs of consumption. For example, legal highs. We live in a world of increasing complexity. Many products are highly complex, ranging from smartphones to a pension. Consumers may simply not necessarily have the information to hand to make a rational, well-informed choice. We also live in a world of asymmetric or unbalanced knowledge, either when the buyer knows more than the seller or the seller knows more than the buyer, and this can lead to suboptimal choices being made. And even in the world of Google and BL and price transparency sites and TripAdvisor, it's hard, that's often, for consumers to get the full information on price to find the best deals in markets. Here are some examples of information gaps and information failure. So, for example, in recent years, we've seen increasing controversy and concern about the overuse of tanning salons, particularly by young people. And that's led to a change in the law on the minimum age for people using these salons. Again, increasing social concern about long-term addiction to over-the-counter painkillers and other drugs, including illegal highs. In the education market, there's a huge asymmetry of information. Many students don't have the full information about, for example, which A-level course would be best to get into the top universities. Parents likewise are searching and scrambling for the right information. There's a whole industry which you could argue is a little bit suboptimal in providing this kind of information for a very high price. Pensions is a world of increasing complexity. A lot of young people don't necessarily understand the law of compound interest and the importance of starting to save early for a pension. But pensions themselves can be highly complex, and the industry has been criticised for making these decisions almost unbearably difficult to make. Of course, we experience information failure whenever we buy a second-hand product. The classic example of asymmetric information is the uncertain quality of a second-hand car. Are you buying a peach, which you'll love for many years and give you great service, or are you driving a lemon off the forecourt, where problems start literally the moment you turn the ignition on? So uncertain quality of products, something consumers need to be aware of. Many of us don't know the full nutritional content and consequences of the food and drink we eat. And in the construction industry, if somebody turns up to perform a home improvement, how do you know whether it's a reputable builder or a cowboy? When you're on a holiday, which hotel do you stay at? Which restaurant do you use? What happens when you're haggling on a street for a product? There's all kinds of information failures that can exist. In other words, the take-home point from this slide, everybody, is that information failures are ubiquitous. Most people make decisions in markets without full information of the costs and benefits of their choices. Here's a good example. Our knowledge about food content and sugar content, for example, could be a factor behind growing levels of obesity. Saudi Arabia actually is ahead of the United States, which is a bit of a surprise to me. And sugar content from soft drinks. In the March 2016 budget, George Osborne pulled a surprise by announcing a sugar tax on carbonated drinks in the UK to be phased in over the next 2 years. It's a big information issue. How many people know, for example, what is the sugar content in grams per 100 millilitres of their favourite soft drink? And here's an example using an analysis diagram of where an information failure can lead to a market failure. We're going to take the example of a merit good, and we have a separate topic on merit goods on our YouTube channel. So in this example, let's say, for example, the costs and benefits of consuming some healthy food, some fresh vegetables, for example, or some fruit. Consumers may have limited information about the true benefits to themselves. And if they have limited information, the optimum consumption choice is quantity Q1, where their marginal private benefit equates with the marginal private cost. But if consumers had better information about the products they were consuming, then the marginal private benefit curve will be further to the right, market demand would be higher for goods where consumers had better information. The absence of that information can lead to a suboptimal level of consumption. Q1 is less than Q2, and that of course would be a market failure. Asymmetric information is really important in markets. So asymmetric information is where there is an imbalance in information between a buyer and a seller. It's perhaps the most commonly used question in year one microeconomics papers. So loads of examples of where asymmetric information happens. A landlord will probably know more about their property than a student tenant looking for accommodation in their second or third year. In the mortgage market, the borrower, the person who's taking out the loan, probably knows more about their ability to repay it than the lender. And of course, if you've watched the film The Big Short, when they went to Miami and they were looking at how these mortgages were being sold, in some cases they made no checks at all about the creditworthiness of the people who were taking out the loans. And that led to a huge financial market failure. Car insurance companies cannot necessarily tell the risk associated with selling premiums to every single driver. So therefore, as a result, they have to pool the risks when setting premiums. As we mentioned before, some students have better knowledge than others about how to get into the best elite universities and the best courses. Doctors have superior asymmetric knowledge about drugs and treatments. Used car sellers know a lot more about the vehicle quality than most of the buyers. And in the stock markets, we talk about things like insider information. People who can make high frequency trades, for example, with that little extra edge of information, which can cause them to make big profits. So asymmetric information is a really, really important aspect of your market failure studies. Just want to make a little distinction between imperfect information and asymmetric information. It's quite important to distinguish this. So imperfect information is a generic term. It just means people lack the crucial information to make a rational, fully informed decision. Asymmetric information is where one party to the transaction, it could be the buyer, it could be the seller, one party has more information than the other. Let's look at moral hazard briefly. Moral hazard is when a party with the superior information, the better information, alters his or her behaviour in such a way that benefits them, but imposes costs on others who don't have the same information. So, for example, in insurance, you can argue that when somebody's insured, they might be likely to take greater risks, knowing that their claim will be covered for by their insurance policy. The consumer clearly knows more about this than the producer. Some examples of moral hazard. It's been claimed that the banking system suffered from this in the lead up to the crash, that banks were taking excessive risk in the kind of background knowledge that they would be bailed out by the financial authorities. Some were, of course Lehman Brothers wasn't. And in dentists, the dentist market, dentists and patients may face the problem of moral hazard. So you go for your checkup and the dentist knows more about what's inside your mouth than you do, probably. And there's of course the danger of supplier-induced demand. So the dentist may suggest that you need some fillings or a crown or some other treatments, when in fact you may not necessarily need it there and then. There's a potential conflict of interest there between dentists and their patients. Just Google dentist horror show for some classic examples of that. Another aspect of imperfect information is adverse selection. And this is linked to, it's another aspect of the asymmetric information problem. Okay, the problem of the asymmetry between buyers and sellers. If we take the market in health insurance as an example, it's probably likely that those people most likely to want to purchase health insurance are those most likely to use it. Perhaps they're smokers, perhaps they have an underlying health condition, or perhaps there's a history of family illness in some sense. Well, if the people who are most likely to use it are the most likely to claim, the health insurance company will know this and may choose to raise the average price of insurance cover for all users. The danger there is that could price out of the market some low-risk consumers, meaning that high-risk consumers get the insurance. And that really is a market failure. The market's failed. Now, of course, the insurance firm might try to counter this by screening potential customers, asking them health-related questions, and perhaps refusing to pay out for well-known pre-existing health conditions. Well, finally, what can be done to address information failure? What are the different types of interventions that can possibly address this market failure? The key, of course, is to give people accurate, better, fuller information so they can make a rational, well-informed choice. So, for example, and there's plenty of points on this slide, things like better labelling, including compulsory labelling on products, improved nutritional information, and lots of advertising campaigns. There's been loads of campaigns over the years about trying to get people to quit smoking, trying to get people to obey the speed limits and not drink drive. These campaigns sometimes have a limited effectiveness, but they become more hard-hitting as time goes on. A couple of points near the end are quite significant there. So, for example, consumer protection laws. People have a legal right to take goods back to the shop, and of course you can take cases of shoddy workmanship to the small claims court. Increasingly, the suppliers themselves recognise the information problems, and so, for example, in the used car market, there are guarantee schemes and indemnities, and testing, multi-tests on products before they're sold. The construction industry has introduced industry standards for and trademarks to certify well-trained, responsible builders and decorators, for example. So industry standards, rigorously monitored and enforced, can be an important part of this. Information failures are common to all markets, and it's important just to have lots of good examples to hand and a feel for what can be done to address the problem. Well, thanks for joining in on this one. More market failure videos on our YouTube channel. See you soon.